Hey everybody, happy Wednesday it is. Someone's got to find out what day it is by looking today. It is. We are about to embark on our trip around the world to talk about real estate. But really, real estate is a macrocosm of things like macro and markets. And there's always that delayed reaction between real estate and what happens on things like stock markets, maybe crypto markets. But there's some nuggets in here that are fascinating. We're going to talk about the impact of Starbucks on real estate. We're going to talk about baby chasers. Yeah, really interesting. And we're going to take a tour around the United Kingdom, Germany, China, Australia, Canada, USA. And as I say, everything, even if you look at American data, it's represented all over the world at the same time. And I'll back that up with numbers as well. And as always, I won't say disclaimer because it doesn't matter, but I do believe everybody needs to own a castle. It's part of the three-legged stool that has helped me a lot in life. And in addition, last time we spoke about why it's so important. And again, you've heard this before. I do this every month, but real estate is still the most popular of all millionaire investments and spending choices, with the exception of Elon Musk. He prefers stock and things like SpaceX, etc. So let's jump in. Let's talk about what's happening, because global GDP growth and inflation have a huge impact on inflation and real estate prices. So global GDP forecast, as you can see across the world, blue is bad, very, very, very negative. Russia is looking pretty bleak. So or other places, I think that's Poland, they're looking pretty blue as well, with negative growths. And then some areas with positive growth, like India. India is a train. China, very positive, expecting about 4% GDP growth, etc. But a lot of the West, like the US, GDP now expects something like 3.9% GDP growth in Q4 and also into Q1 2023. And I don't know what they're looking at, but we'll see. I expect some bad news to happen now. Inflation, which is a big driver of why real estate's coming down, is because interest rates are going up to try to put the genie back in the bottle. Here you have inflation forecasts. Obviously, places like Argentina, down south, we know aren't very well. Turkey in the middle, and a lot of other green too. Some of the colors across Europe are a bit messed. Most of Europe now is under 10% inflation, as we see from data, but there are some hot spots as well still there. In fact, Canada and Mexico look darker than the US, which now is quickly barreling towards 3% inflation. I expect inflation in the US to have a 3 handle sometime in 2023, because it's coming down fast, especially when we see things like energy prices, oil prices tanking hard right now as well. So let's talk about last time we visited. We talked about the biggest real estate bubbles in the world, and we'll see how they matched up. So we're talking about cities like Vancouver and Toronto, Frankfurt, Munich, Zurich, Hong Kong, Tokyo, Sydney 1.19, and let's see how they all did, as well as places like Los Angeles, New York. Let's see how the stuff has mapped out and exactly what's happened since last time. And again, even if you're not in the market to buy a house, there's some things here that you will pick up. So next time when you are in the market, you'll be able to time your buy and also look for key indicators that will help determine which markets are growing the fastest. So a quick view of global markets. Some housing markets have turned, others are about to. Obviously, the big one there, the blue bar, is the 2022 estimate for housing prices, and red is the 2023 forecast and how much they're going to fall. Obviously, 2022, the estimate is Australia has fallen quite a bit, about 8%. The expectation in 2023 is maybe another 10%. We'll talk more about Australia later. Canada, big dip. Let's see if that's already happening. US, 3%. I think that's a BS number. UK, around 6%. There's actually a little bit of good news about the UK as well to share, because they've had a lot of bad news in the last year or so. And Japan, positive. Brazil, positive. So let's see exactly what the data says behind all these countries. Let's start with the US. Now I'm going to go into detail around what's happening, but remember, it's a microcosm of the rest of the world. So first of all, you can see here, April 2022 was the appreciation top, and you can see national home prices increased year over year, despite being a crummy year in 2022. Real estate still end up, but you can see the trends are coming down. Now, what's interesting about this chart It breaks the market into three different areas. One is the entry level in teal. The move up is kind of like between entry level and high-end housing, which is purple. The move up is yellow. You can see the entry level houses are crashing fastest first, which normally the cheapest things to buy are the ones that fall fast. Think meme stocks, for example. And here, I think prices rose about 11% for entry level to about $339,000 in the US, 9.6% for move up to about $527,000, and 7.8% for high-end homes, which average around $904,000. So you can see that the entry level to the high end is 3x the price approximately. So let's jump and talk about the odds of recession before we go into housing detail, because this has a huge impact on home sales and home prices. Now, as you can see, per the surveys from Bloomberg, the December survey says we are 70% chance that we're going to have a recession in 2023. So a lot of people believe that. If you ask the real experts in the world, they'll tell you it's 100% certain it's going to happen. But let's dig a little bit further. Let's talk about one thing which is really funny: baby chaser index. And why is this important? If you're going to think about where you're going to raise your family, you need to look at things like schools, etc. But there's a related aspect to this. And these are how the top cities have developed between 2019, 2020, and 2021 in the United States. Austin was number one in 2019. And for the baby chaser index, let me explain what that is. So millennials are now the largest home buying cohort in the United States. And where millennials go, the baby boomers follow. So baby is the baby chaser. The baby boomers chase the babies that the millennials have, because grandparents want to be beside their grandchildren. That is based on research, etc. So globally, Austin, Texas regained its position as the number one baby chaser market after coming in second in 2020. And the two largest metros in North Carolina, Raleigh and Charlotte, round out the top three for 2021. Then you have areas like Nashville, Tennessee, Dallas joined the top 10 in 2021, while Indianapolis, Denver dropped out, and every baby chaser market in 2021 was either in the Southeast or the Southwest. That's what they call the Sunbelt here. So people want good weather, good schools, families go for jobs, grandparents, parents follow, etc. So that is an interesting thing to look for as you're looking to buy your next castle if you are in the US. Another interesting piece as well, this is a Harvard study. They talk about the gentrification of neighborhoods and areas. And typically what they did was this school paper used Yelp data to find that the entry of each new Starbucks into a zip code is associated. Now this is each new Starbucks, not one Starbucks per zip code, but each new Starbucks is associated with a 0.5% increase in housing prices within a year. If they open up 10 Starbucks in a zip code, that's a 5% increase in housing price. Stunning numbers. Now, the presence of a Starbucks is far less important than whether the community has people who drink coffee, but it does impact the real estate prices. And that is a stunning tool too. So if you can get access to information where they are going to build a Starbucks, buy a house. So anyway, it's fascinating. Let's talk about some data in the US. US single family and multifamily housing starts. You can see here through November 2022, we don't have December data yet, but year to date, total starts are down 1.2% compared to 2021. And we'll finish the year around 1.55 million. And that is not enough to deal with the growing population, which isn't actually growing that fast, but still not enough. And note that housing weakness in 2022 was in single family starts, red, the red line here in the chart. And single family starts year to date are down 10%, whereas multifamily starts, which are 5 units and up, are up 17.8%. So the big trend is people can't afford or aren't buying single family homes. They're buying townhouses and condos in big complexes and buildings as well. So and by the way, as I've always spoke about too, things like single family homes appreciate better over the long haul than townhomes or condos, for the record. So if you can buy a house, buy a house. Now, new home sales since 1963 to November 2022, they decreased at a 27.1% annual rate in Q3. Now, again, we don't have Q4 full data because December is missing, but RI will be down, which is residential investment, will be down sharply in 2022 compared to 2021. And year to date, new home sales are down a ton as well. We'll talk about those in a second. So let's look at new home sales, down 35.9% from a year ago. You can see it pretty clearly from the chart and from where the top was. Let me try zoom in to where the top was. It was August, September 2020. That was the top of new home sales in the United States. So that's a staggering dip. In addition, this is another element which is important. We always talk about the whole housing, real estate, property market makes up 25+% of GDP. But RI, which is residential investment, was a huge drag on growth in 2022 as the housing market slowed sharply. And through November, starts were down again, 1.2% year to date compared to the same period in 2021. And new home sales are down 15.2%. And basically what this is just sucking the life out of GDP, and the impact of that is shown in the chart here as well. And I expect this red line to dip a lot more down over the coming quarters as we go forward. Now let's talk about PSI. This is the pending sale index in the US. This was created to help account for fluctuations in supply by combining both total sales volume with the average sales rate per month per zip code. Now the November PSI came in at 104, representing another 38.1% decline from the same month last year. And the index is currently 41.8% below cycle highs. And on a month-over-month basis, seasonally adjusted, new home sales did actually pop up a tiny bit. That little nip is about 4% worth. But we're not sure why that could be. Sometimes people pause, wait, renegotiate, wait for financing before they can actually get things in place. We will talk about financing in a second too. So here, banks are tightening. I covered this the other day, and this typically predicts a recession. I always say as well, sometimes when they start tightening, it's normally too late to put the genie back in the bottle, but delinquencies will be on the rise as, the Fed financial Armageddon continues. In addition, mortgages are not widely available in the US. This is the NBA Mortgage Credit Availability Index, and we are down at global financial crisis levels. This also reflects the kind of bank tightening that we see right now as well. And talk about affordability. The cheapest place to buy a house in the US is Cincinnati, Ohio. Big thank you as well to Sanjay for getting me this chart. And the most expensive place in terms of affordability is Los Angeles, right beside San Diego and San Francisco and San Jose. So the four most unaffordable places are all in California, believe it or not. Anywho, moving on, where prices are falling fastest, remember, least affordable. Wait till you see this one. Here, declines obviously are not equal across the country. Chicago, Cleveland, Atlanta, and parts of the East Coast, like New York and Miami, have seen home prices decline less than 2%, which is surprising. I thought a lot of people would leave Chicago because of the murder rate and the taxes and stuff like that. And I used to live in Chicago myself. But many people in these markets are saying home prices are not declining. They aren't wrong. But look at some of them. Look at the one on the far right. That is San Francisco, and followed by Seattle, followed by San Diego, followed by Los Angeles. So certain markets are falling very, very fast. And the biggest, most expensive markets sometimes fall the fastest. But this is in contrary to the one above that showed the entry-level homes are falling fastest right now as well. So it's just a perfect, messy cocktail of badness out there in the real estate market. So San Francisco, the 4-month, month-over-month annual change is down 27.9%. And this is staggering unto itself. So let's switch gears. Let's go for a global tour real quick. Now remember, all that detail for the US is pretty much reflected in other parts of the world. Let's talk about the UK market. And there is a little bit of good news for those who are still awake over in the UK. Bad news first. The UK is experiencing the sharpest drop in living standards ever. That little gray bar there reflects the period between 2022 and 2024. It's kind of includes some forecast. And the 2-year change is the red bar as well. Never in the history of the world has real household disposable income per person fallen so much in the United Kingdom, which will have an impact on things like housing and stuff. But a lot of this is to do with inflation. Inflation, last time I checked, was north of 20%, while most of Europe is just under 10% right now. So there is a big difference between what happens in the UK and what happens in the rest of Europe. Let's look at Brexit. Brexit did have one advantage. So the 2016 vote to leave the European Union prompted a lot of international investors to pour more capital and move their businesses and enterprise to other parts of Europe as they break by the UK from its biggest trading partner. And this created a lot of uncertainty. This also helped stoke hot demand for buildings in cities like Paris, Berlin, Milan that forced prices to record levels with the help of cheap debt. So the UK didn't fly up as high as many European countries. Therefore, it's not falling as fast. So that's a positive. But there are still a couple of headwinds there. First of all, buyers are bagging deals in the UK right now. If somebody's asking for £1 million for a house, people are getting it for 97% of that value. So people are negotiating and things are not selling for their asking price. And there's been quite a dip as well. This is a chart of the percentage of asking price achieved. And you can see how it's tanked. In the past, it looks like people in the UK were just paying 100% of whatever was asked. Now it's 3% less, which is substantial as a percentage. Let's also go and talk about the mortgage shock in the United Kingdom. It is very, very real. And many financial experts expect mortgages to stay near 5% until at least 2028. And that is a hefty load, considering that mortgages were just around 2% not too long ago in the United Kingdom. In addition, the UK pulls first-time buyer mortgages. It pulls 60% of mortgages with low down payments. And this is also hurting first-time buyer markets in the UK, which is not good at all. And obviously, there's a whole bunch of other bad stuff, but some good. Prices aren't going to fall as fast. It is a very stable market. And there is also still apparently a lot more demand for houses than there is actually supply, which will help keep things very inflated. Also, the cheap British pound, relatively cheap, is also attracting foreign investors again out of other parts of the world like Malaysia and other parts of Europe. Let's switch gears and talk about the Canadian market real fast. Hope it's not too cold up there like it is in other parts of North America. But here you can see this title, Canadian housing has crashed in 18 markets so far. Biggest drop, London, St. Thomas, 26.1%, Kitchener, Waterloo, 25.8%, and Cambridge, 25.1%. All three markets have officially crashed. Now, you can imagine the Canadian market has kind of cooled off. A lot of it has to do with the increase in mortgage rates and lack of economic certainty in the marketplace. Let's dig into what the different provinces look like, because this was fascinating. All Canadian markets are dropping, with the exception of New Brunswick. That's up 9.2%. February 22, the peak was about $816,000 for the average house sold in Canada, and it's now 22.5% off that high. This means the average home price in Canada has now fallen by 22.5%, or close to about $184,000, just in 3/4 of a year or 9 months. And this has occurred at the same time that the Bank of Canada rate hikes, which started in March 2022, have more than doubled interest rates. Mortgages were 2.45%. Now they're averaging about 6.45% as of December 2022. But what I added to this little chart here, I added some percentages. If you go to BC, Vancouver, the whole of BC has fallen 8.6%. Alberta, minus 1%. SK, I think it's Saskatchewan, but I always get the name wrong. I could be wrong. Minus 9%. Winnipeg, etc., minus 0.7%. Minus 10% for Ontario. Quebec, only minus 1.2%. So that's a very stable market. And again, as I mentioned, New Brunswick up 9.2%. So pretty interesting revelation. And these are the market trends in Canada on the grand scale over the last 2 years exactly. The orange line is the average selling price. And you can see it is still higher than it was 2 years ago. The price is still up about $37,000 on average from 2 years ago. Again, there was a big change in that whole 2020 COVID year. But the number of transactions is down to a 2-year low at about 30,000 transactions from the high, which is about 80,000 transactions. So that's a little bit of a recap of the Canadian market. Let's go over to Deutschland real quick and see what's going on over there. A couple of interesting findings here. One is, what is the ECB going to do with rates? This is a piece from the Financial Times, and the question is, when will the ECB stop raising rates? And the majority of economists, professional economists, and they interviewed, I think, about 90 of them or 100 of them, they believe Q1 2023, the ECB will stop raising rates, and at the very least, it'll happen in Q2. Only very few believe it'll happen in the second half of 2023 or 2024. So that's good news. But remember, the ECB follows the Fed. Lagarde's playbook comes from Jerome Powell. No offense to either individual, it's just the way it's played out in 2022. In addition, now, this is an important point. I always say that we have a lot of German people in the audience, but it's very, very important to own your castle. But this stunned me. Germany has the second lowest real estate ownership in all of Europe. And you can see here where it lies in the chart. And just a quick reminder, the Gini coefficient is calculated by comparing the distribution of a certain variable, in this case, home ownership, with a perfectly equal distribution across the whole of the OECD, the European countries. And it's often presented as a percentage with higher values indicating greater inequality. And this is why it's kind of bizarre to see this. Anyway, it's more common in Germany for people to rent rather than buy their homes. But finally, the German government has put in place policies that will support, hopefully, people buying more real estate soon, instead of promoting protections for landlords and make it easier for people to rent properties. But again, why let the landlord make all the money? Let the individual buy property. So I don't know what the status of the taxes and other things and incentives, but hopefully rates will come lower again and people will be able to buy more property in Germany. But that being said, it's also not good for the landlords that are there, because German real estate is expected to fall 25% from peak to trough. And it has been a very strong market for decades, but it faces its first serious fall, even worse than the global financial crisis, according to some analysts at Deutsche Bank. And that is a scary time, especially when it comes to people that have recently bought real estate. That could hurt. Next in the box is the Australian market. Real brief, let's touch on this. And across the capital cities, the month-to-month decline ranged from -2% fall in Brisbane to a -2% drop in Perth. Melbourne fell 0.8%, Sydney dropped 1.3%, and Hobart fell 1.1%. Probably because all the yachts left the other day, I'm only kidding. But across the regions, monthly falls of more than -1% were recorded in New South Wales. I think it was about -1.7%. And if you look at the annual return, you can see Sydney is faring the worst at -8.6%, but Adelaide is up 16.5%. So again, the big lesson I'm learning here is real estate is very, very much local based driven. It's not on a macro base. The whole country doesn't fall, just like Canada we showed before. So spot those markets that are growth. In the US, that would be like Austin, Texas, where the population is growing very fast. And the baby factor is also a factor with the boomers coming in. In addition, one of the reasons why Australia is kind of strong is the Chinese are a dominant force in the Australian real estate market. And they are jumping in and they're snapping up as much as they can. And the Chinese are doing the same thing in Vancouver, Canada as well, buying up all the condos. Speaking of the Chinese, last one in the box, the Chinese market, this is the Chinese consumer confidence. It's in the toilet. Boom, hovering down there around 87, 88, which is almost close to a record low. China's been on a growth trajectory for the last decade, but this also is hammering the housing market. It's also hammering things like Tesla and new car sales. So hopefully this will recover. And I've seen this recover very quickly. It falls very fast, but China can actually bounce back very fast. And a big part of the confidence hit also is due to COVID lockdowns, and that's all going away. Thank goodness. Next, China building, though, is still in extreme distress. This is a list of China Real Estate Composite Index in orange, the market conditions subindex in blue, funding conditions subindex in green, which is actually peaking up a little bit, and the activity in gray. Everything is tanking, but the funding conditions sub-index is coming back, which means the Chinese property stocks are starting to enjoy a reopening rally. But remember, the rest is still in a shambles out there. A final note, this is the pricing action in China. China's property stocks may be recovering, but home prices are not. 14 months of straight decline as we go forward into 2023. So that's it for now, everybody. Again, the lessons here: follow the Starbucks, boomers follow the babies, follow the high growth in population, watch where the money is going to be, watch where the Starbucks are going to be, watch where the babies are going to be. That's where you plan your next buy. And wait, we're not out of the woods yet. A lot more havoc to come. The bottom of the real estate market I thought would be Q1 2023. Back in summer 2022, it looks like it might be Q2 2023. But we'll watch this very carefully. And I hope you like this real estate edition, even though it's not crypto or stocks or anything else. But let me know in the comments below if I should keep it going. Thank you all. Thank you everybody in the audience. Thank you all to the mods in the chat. And I will see you all soon. If I can figure out how to turn this off. There you are. Bye all.